Really excited to be talking to everyone about farm and agribusiness management in the ad hoc era. Jenny Ifft, I'm an associate professor and extension specialist in agricultural policy, and I'm joined by my colleague, Dr. Brady Brewer, who's an associate professor in the Department of Agricultural Economics. Um, I'm going to start out this webinar discussing some sort of motivation and context for why we are in an ad hoc era of farm policy. And then Brady's going to take over talking about managing for potential ad hoc payments and how to spend those payments, or some strategies or trade-offs for how you spend and use those payments when they're received. I also want to say this is the first time both of us are presenting on this topic. So we really appreciate your feedback and engagement. What are the questions you're interested in? What did we cover that you were looking forward to? What didn't we cover? That'd be really helpful so we could support producers in this area and producers, lenders, agribusiness as well in this area moving forward. So first of all, what is ad hoc? What do we mean by ad hoc era? Ad hoc payments, those are payments that are unplanned or as needed. They happen a couple different ways. Sometimes they're initiated by Congress, and sometimes the USDA authorizes these payments through the Commodity Credit Corporation, the CCC. So we've seen large ad hoc payments going back to 2018 with the Market Facilitation Program, which was used by the first Trump administration. We saw more ad hoc payments related to the coronavirus pandemic. And then we've had ad hoc disaster payments in the past couple of years through the Emergency Relief Program. Last week, we presented on economic assistance payments and disaster payments authorized in December as a part of the American Relief Act. So we're continuing to see the ad hoc payments being authorized. A little bit about the mechanisms. First of all, the Commodity Credit Corporation. This is a government corporation with no employees. It's basically a funding mechanism for the USDA. 10 years ago, to be honest, I didn't pay much attention to the CCC. Now I teach about it as a part of my agricultural policy class. It's become a key part of the farm safety net. Historically, the USDA secretary has had broad authorization, authority, or discretion to use the CCC funds, and typically for sort of minor disaster programs on an as-needed basis. This authority was taken away during some of the Obama the years of the Obama administration, put back in place in 2018, and that's when the discretionary use for ad hoc payments started increasing. Congress can also authorize ad hoc payments, so this could be standalone legislation. It's a CARES Act, so during the pandemic. It could also, what we've seen in the past few years, it's a part of spending bills that help keep the government open. Those disaster payments are put into those. Then I want to talk a little bit about how this fits in farm policy historically, different parts of the farm safety net. So I've made a timeline here. Now, I'm not really, it's hard to say what year did this era end and did this era begin. Usually they don't start out of the blue, so that's not as important here. But broadly, the farm safety net from the Great Depression through 1996 was based on price supports with supply management. So the government was involved through loan programs in setting the price of major commodities and then taking several steps to attempt to manage the supply of those commodities and sometimes storing those commodities. That completely ended, or nearly completely ended, in 1996 with the Freedom to Farm, the FAIR Act. And early 90s, we entered the risk management era when crop insurance became a major part of the farm safety net, still is today. So that's the yellow, the risk management era on top. What's happened in recent years is that ad hoc payments, this ad hoc era we're in terms of the size and scope, rivals crop insurance. We tried decoupling from 1996 to 2014. So there's production PFCs, production flexibility contracts, and direct payments. Through those years as a part of the Farm Bill, those turned out not to be politically feasible. We don't have fully decoupled payments anymore, but a lot of the Title I programs, ARC and PLC, price loss coverage, agricultural risk coverage, those are partially decoupled. So they're you only get those payments if you have base acres or historic production. So there's an attempt there to limit the impact of farm safety net programs on production decisions. So you can see there's a sort of three-legged stool to the farm safety net. You have crop insurance, Title I payments, and ad hoc payments. What we've seen since 2018, the Title I has become a relatively small point. If you look at this, is total expenditures here. So in $1 billion, it was the highest in 2020, 6.2 million. On the column here, crop insurance, we have the total premium subsidies. These are the producer premium subsidies. There are other expenditures associated with the program. I'm putting the producer premium subsidies here, and you have the indemnities. So those are as high as 19 billion in 2022. And those crop insurance premium subsidies range from 6 billion, peaked at 12 billion. Those reflect high prices during those years. Down to around 10 billion in 2024. Look at ad hoc payments, as high pandemic related payments, 29 billion in 2020. MFP payments, 14 billion in 2019. So, rivaling crop insurance in size and scope. Relatively large disaster payments, especially compared to Title I in recent years. And then it looks like 2025 will have at least about 10 billion in economic assistance payments. Could go up to 30 billion depending on how fast the disaster payments get out and who those go to. So I also put this in a chart so you can have some idea of those trends visually. So this is U.S. net farm income. That's the blue from 2008 to 2024. So it stacks up. This is net farm income less selected payments. The red are ad hoc and disaster payments. The green would be crop insurance indemnities. And the yellow is all other, mostly Title I, a few other things. Does exclude conservation. So you can see here that ad hoc payments have been a substantial share of farm income from about 2018. Crop insurance plays a big role as well. This is for the entire U.S. You look at it for Kansas, similar. The blue, that's net farm income. The green is crop insurance payments, so pretty big in years where there was a lot of drought here in Kansas. Ad hoc payments, pretty substantial share of farm income, especially from 2019 to 2021. And again, we're expecting sizable payments in 2025, although those haven't been released by FSA yet. You could also compare these different types of payments by their share in total government spending. So this chart goes all the way back to 1996, when the yellow Title I was pretty important. You can see in recent years that ad hoc and disaster payments have played a larger role. We did have some disaster payments around the Asian financial crisis and commodity price drop in late 90s, early 2000s, but those eventually decreased. We expect this, again, ad hoc to be higher in 2025. Next, same chart, but for Kansas, where you really see the importance in recent years of both crop insurance and ad hoc payments and total safety net spending. So you could argue that we are in an ad hoc era of farm policy. These payments have been large in recent years in some cases, but not always larger than crop insurance, depending how it's measured. they've also been durable across administrations. Both administrations with different parties in control of Congress have used these programs. Part of this could be because, crop insurance is based for most crops, crop insurance is based on the current market price. So that's what that uses. So if you're in a low price period, your crop insurance guarantee could be relatively lower. In terms of Title I, ARC and PLC, we've had a couple extensions of the Farm Bill. Also, some of the budgeting rules have potentially limit how much Title I can be expanded. So we're not seeing any indication right now that this ad hoc era is going to end with the current administration. Now, I don't have a crystal ball for any of the politics, but there are two pieces of evidence. First of all, the American Relief Act, a lot of things got taken out of it, but agricultural aid, the economic assistance payments and disaster payments, those stayed in. There was broad support for keeping those payments in there. Also, the testimony of the Secretary of Agriculture, nominee Brooke Rowan, said that she was planning to use her CCC authority in the case of a trade war and retaliatory tariffs. Of course, it's politics. There's a lot of open questions. One is, if we get a new farm bill, are you going to see some changes to Title I to get higher payouts or some expansion of disaster programs? So that could potentially happen. So there's conversations we could have. What are the implications of ad hoc payments? How effective are they? Is this the type of farm policy that people would like to have? But what we want to do here instead is try to think through, this is the era that we're in. This is the environment we're in. How do you manage in this environment? And with that, I'm going to let Brady take over.
So thank you, Jenny. I want to see if okay, I think I have control of the slides now.
Yes, you should.
So, so first off, if anyone has any questions, please put them in the chat. We are kind of entering this, as Jenny puts it, this new era of farm policy where ad hoc is a majority of the farm program payments out there. And I think that there's several key implications. So what we're going to kind of continue with is some management decisions and how to think about, and Jenny, just because I think this is relevant to what you just spoke about, we have a question in the chat of how is the CCC funded?
Yep, I can just answer that here. So basically the USDA with the CCC, they are effectively borrowing funds from the US Treasury, and then at the end of the fiscal year, Congress appropriates to pay for that. So it gives USDA authority to spend flexibly, and then Congress comes back and covers that. So that's the basic mechanism. But it's government spending. So.
Yep. So with these ad hoc payments, and especially with how they're funded with CCC, there's some key differences that when we think about managing these payments that lead to maybe different financial behaviors that we may see elicited with how people manage their farms or agribusinesses. So first off, so as Jenny said, these are much more variable. They're at the discretion. They're not kind of written into law with how they're funded. Yes, there may be formulas and how they eventually get distributed, but these formulas aren't known until announced. So if you think about key differences between how these ad hoc payments work and maybe say crop insurance, and these Title I payments are more traditional farm bill payments, right? Those are expected revenue where they're roughly known in advance. And I realize that there's always exceptions to the rule, right? Catastrophic weather events or something like that. But if you're a producer and we're in a certain weather climate, maybe a drought, and you're seeing yields go down with less rain, you should be able to figure out, okay, here's what I would expect my yield to be, and this would trigger X amount of indemnity payments, or in the case of ARC or PLC payments, you could figure out roughly, okay, I know I'm going to get roughly this amount of payment at the end of the year. Because those formulas are known, in advance. But with ad hoc payments, the degree to account for payments that just haven't been authorized or unknown when making production investment decisions just make it extremely variable. And then we have this question of, because there's variable and you may not know the amount you're getting until at the 11th hour, how much to spend on these payments once received, when you think about tax implications and so forth. They're managing them just seem to be a little bit different on the surface. So I like to consider these ad hoc payments as what I call a strategic risk. So strategic risk. So for those of you who haven't seen me speak before, my main area is agriculture finance and agribusiness management. So I do a lot on the agribusiness side when thinking about firm strategy and financial strategy. So I think a little bit of this high level, how do we think about these risks differently from maybe some of the other risks producers face, such as price risk or weather risk. And these are what I call an external risk or strategic, which is stuff that we really can't manage. So there's three key areas that we need to think about here. One, our strategic positioning of what we're doing to manage these risks, our internal resources and capabilities that we have to overcome some of these risks, and then the external forces that may be shaping or impacting the risks that we're facing. So, other sources, to put this in context, other sources of maybe the strategic risks that farms face. Obviously, this falls into that first one, the government and policy change, but geopolitical conflict also fall into this category as well. We think about some of the geopolitical conflicts across the globe right now, thinking about Ukraine and Russia and what it has done to the global trade routes and some of the grain markets and what it's done to prices and supply. That's something that we can't actively mitigate from. There's not a risk mitigation system out there other than maybe planting different crop rotations or something like that. Disease, change in consumer preferences, shifting weather patterns, technological uncertainties all fall under these kind of broad strategic risks that we face as an agribusiness or as a farm. Okay. So the other thing I want to kind of set up before I get to some of these management strategies or maybe some frameworks to think about how to manage through these ad hoc payments. I first just want to set up that there's evidence out there that how these payments are paid out do change how we see farmers impact their balance sheet and income statement. So there's evidence that when you think about decoupled payments, so more of a direct payment that's not tied to production or price, we tend to see farmers pay down debt with those decoupled payments, because decoupled payments are some of the most expected, right? Since it's on a per acre basis per se, these are, what these are going to be long in advance. And what we see here is more of a consumption smoothing effect where recipients of decoupled payments may plan by paying down debt on the balance sheet from those. We see similar impacts from CFAP payments that were made here recently. We didn't see them impacting debt, but what we did find is correlation with being on time with payments on your production loans or not. So farmers were using those to go pay down short-term, intermediate production loans. MFP payments, well, we didn't find an impact on how that impacted a farmer's balance sheet from the debt side. We did see an increased willingness to store grain as farmers shifted income from one period to the next. So we saw big increases in grain storage because we had this ad hoc payment being paid. So the type of payment does affect how farmers choose to deploy liquidity and equity across the farm. So the type of payment and timing influenced how farmers strategized in terms of using the farm program payments because of the predictability and timing of these payments. So why would ad hoc be different? Well, if you think about traditional farm bill programs, kind of going off of what I was saying earlier, when a government payment is announced and it's reliably trusted, in other words, the government says, hey, there's this formula that's going to determine how you're paid based on acreages and crops. you may take on new debt to access that cash flow earlier. If the payment's going to be paid in December, but you need the payment now to pay for production expenses, that's what we call consumption smoothing. It's taking on the expense now and knowing that you'll be paid back later, and then your expenses are smooth throughout the year. It just shifts the expense from one time period to the next. We can think of this the same way as people who have a monthly paycheck or a biweekly paycheck or bonuses or since tax returns are known in advance, revenues and expenses hardly ever match. And that is super true for agriculture, right? Farming is exhibit A for expenses not matching timing of revenues. So what this just allows for is the more we know for when something is going to be paid out, we can better plan our expenses to smooth out our expenses over a year, helps with tax planning and so forth. But with these ad hoc payments, since we don't know until they're announced, and sometimes the formula may be decided at the 11th hour, just the known amount that we're going to get makes it hard to plan. So ad hoc is much more variable in certainty and timing. And there's kind of 5 distinct areas that I'm going to call out of what makes farm planning or business planning a little bit harder in this case. First, as I've said, the predictability. Since they're not known until they're announced by the government, there's not this bill that covers, like the farm bill that covers multiple years where we can go to, hey, this is set legislation that's been voted on that'll trigger if certain conditions happen. The predictability is just a lot less. Also, the size of the transfer is a lot more variable. We don't know, the formulas aren't determined until it is announced a lot of times. State of the world, a lot of these, as Dr. Ifft mentioned earlier, a lot of these are in response to maybe or similar to disaster payments. So the state of the world is also a lot more variable as well. Also, because of this, in the consumption smoothing example, our cost of borrowing is a lot harder to plan if we want to maybe take out a loan to have that to spread our expenses out throughout the year. This just creates as well other demands on farm liquidity and equity that we now have to plan for. Overall, ad hoc payments, while we have seen them become a larger share of farm program payments that go out to the agricultural sector, it just makes planning harder because now there's a lot more unknowns that we have to manage around. Okay, so if there's one thing that becomes more variable, my advice is we need to focus in on what we can control and other risk management strategies. So thinking about our other risk management tools that are out there, crop insurance or marketing, as well as just our managerial strategy and our planning, broadly speaking, we have to be able to control better implement those things that we can control because we're now introducing this new variable into the mix. So I told you all that I think about agribusiness strategy. So I want to introduce to you what I think about which is what I call the 5 managerial levers. And step 1 in this process is having a plan for each one of these levers. So thinking about whether in your farm or your agribusiness, managing each one of these 5 levers and having a plan for it. So 1, output price, managing the price you get for what you produce. So again, if we're introducing this new level of risk or new risk into our operation, how can we reduce risk in each one of these 5 levers? So marketing plans are going to become crucial for managing that price. Managing the yield that you produce or how much output you are trying to produce is also going to be critical. Keeping costs in check, managing how much it costs you to produce, managing the asset side of the business, and then as well as managing the people that help with these other 5 managerial levers. Okay, be strategic. with these 5 levers. And I'm going to go into kind of each one of these 4 individually here because I think they're particularly tied to this ad hoc payment issue. So first, manage working capital, thinking about interest rate risk as debt could be more costly here in the future, monitoring debt service, and then prioritizing needed expenses. Okay, so let's go into each one of these at kind of one by one. So we're introducing this new risk. Normally, when I talk to audiences, when I think about current ratio, so current ratio is your current assets over your current liabilities or what you have on hand to pay for what you have coming due. Looking at the FinBin numbers, the University of Minnesota FinBin numbers from a percentile, the median current ratio in 2023 was 1.95. So the interpretation of this 1.95 is for every dollar of current liability, half the farmers had $1.95 of current assets. This could be cash, grain in the bin, or other inventory items that can be sold, that can be turned into cash fairly quickly. Normally, we recommend having a current ratio of greater than 2. I know in some periods, especially time periods where commodity prices like today, commodity prices aren't where we would like them to be, that may be fairly unattainable. But my point here is having that buffer. Since we don't know, hey, if a disaster happens, if we're waiting on an ad hoc payment that may or may not be announced and may or may not be the timing we want it to be, having extra, what I call runway, leeway or buffer in our business that can get us through until we have that ad hoc payment come through, if it does get announced, is going to be critical from a risk mitigation perspective. So we normally advise farms to try to attain a current ratio of 2. I think the question here that we should ask is, should we be okay with depleting working capital further to avoid interest rate costs, which we've seen in the USDA data? And should we try to extend out and build up working capital to have more of a cushion in this ad hoc environment? What that is, should we try for 2.25, 2.5 in terms of the working capital requirements we have on hand? I think that's going to depend on your personal risk appetite and what risk you are willing to take on for the farm or your agribusiness, with how much runway you want if ad hoc payments don't come to fruition, since they are a little bit more variable. Thinking about just showing you to benchmark yourself on your farm or agribusiness, here is the average current ratio since about 1999, so over the last 20 or so years. Since about 2019, farms have been building up liquidity. We peaked with an average of 2.77 in 2022. Obviously, with lower commodity prices in the corn and soybean sector, liquidity has decreased. We don't have 2024 numbers yet, but liquidity is on the way down since the peak in 2022. Some of this is due to higher interest rate costs. We've seen farmers shift from using production loans to using their own cash reserves or liquidity to avoid the higher interest rate costs that we have seen over the past couple years. A key question for me would be that trade-off between liquidity risk, so that buffer, that runway, and interest rate costs that we incur on the farm. So speaking of that key trade-off here between that liquidity buffer, that current ratio, and interest rate costs, here is from the University of Minnesota, the FinBin numbers for farms across the nation. The interest expense is a percent of gross farm income. And in general, we've still seen this even with higher interest rate costs after 2020. And I know interest rates didn't really start to really take off until 2022. So we would expect this graph to kind of reverse course and start to go up. But to benchmark yourself, on average, it's interest expense as a gross farm income at the end of 2022 was about 2 to 2.25%. So for every dollar of gross farm income, farms saw interest expense be about two pennies on the dollar of gross farm income. So it has been decreasing, but we do expect, if you look at the Kansas City Fed data and the USDA data, we do expect this to increase here over the next few years. Okay, so again, it's that trade-off between liquidity risk, that runway, and the income, the margins we get because of the increased interest rate expense, okay, for the debt we get. We've also seen a decrease in margins, okay, so we fully expect these two measures, so operating profit margin, asset turnover, to be a little bit more variable over the next couple years if we stick with this ad hoc payments, because again, it's going to be more variable in terms of what we expect coming from these ad hoc payments based on the formulas that are given. So that's kind of the risk issue of thinking about, do we need increased liquidity requirements and that increased runway? Again, that's going to be based off of your risk appetite. Thinking about the spending plan. So I mentioned this consumption smoothing effect that we see with pretty much all businesses. When we have payments that are expected or known in the future, we will shift expenses around where we need them based on tax implications or just business needs. So my urge to you is have a spending plan in place. When revenues can be predicted, it becomes a lot easier to plan out. We can prepay. But what should our strategy be considering in light of ad hoc payments? And this goes back to that question of what risk are you willing to assume as a farm or an agribusiness? So an example strategy I will throw out there is where you may normally prepay expenses to shift expenses where you need them. What if we don't know if something is going to be announced or if these payments are going to be a little bit more unknown, maybe we split the difference, and where we would normally prepay, would we prepay for half and then wait for the other half to come through after we've been paid the payment and we know what the farm program payment will end up being at the end of the day. Okay, that's good. Going to be based off of your risk appetite. The riskier you want to be, maybe prepay all would be the most risky, where you go ahead and treat it like normal, prepay all, shifting to this period, and then hope that the ad hoc payment makes up for it and you can consumption smooth. That would be a riskier example of that, or keeping everything, not prepaying anything if you don't think the program payment would come to fruition, and waiting till the end. At the end of the day, have a strategy in place if you haven't prepaid expenses for if a program gets announced that will get implemented in a quick manner. Okay, have a strategy in place if that were to happen. An example of a decision checklist for maybe more durable asset spending. So with these ad hoc payments, since they are a little bit more variable, what I would encourage you to do is to have an example of the needs of the farm or the business that you're in, so that if something does get announced, you're not caught flat-footed, and you know, hey, I've already done the strategic planning. Here's what I need to focus on if this payment does come through for tax purposes. So thinking of an example checklist, I tend to break this down into two broad buckets. The first is figuring out so this is for equipment, but this could be for any asset that you need in your farm or agribusiness. What equipment do I actually need? Okay, so for the farm example, these are 4 questions that would help strategize. Here's where I should focus my efforts. And then the final 4 questions would be, what are the financial implications if this were to happen? Okay. So here is a management checklist that I would encourage everyone to do. And this is just thinking about being prepared for these ad hoc payments and having a plan. So this is a checklist, and I know that these slides will be distributed, so you have this checklist in the slides. Uh, what you do is go and rate your business, your farm, or your agribusiness based off of this grading scale. So first, knowing your cost of production. If you have a written document that details out your cost of production, whether it be enterprise budgets, your income statement, you know what it costs you to produce, that would get you 3 points. There are bonus points as you go along here for certain strategies, but if you have a written cost of production plan, that would get you 3 points. If you roughly know your cost of production, it's in your head, that would get you 2 points. And if you don't know, it would get you 1 point. Okay. Be honest when you're scoring yourself. Okay. For each of these. So you do knows cost of production, knows cost of production by your enterprise. So if you have a wheat and a cattle enterprise, do you know it separated out for each crop or product that you grow? Do you have family business goals? Do you have a record keeping system? Projected cash flow is going to be key. Thinking about, again, the variability, these ad hoc payments, and that runway that I'm talking about, being able to project out, here's what we think our cash flow is going to be over the next growing season, will help in managing these ad hoc payments. So is it a written cash flow? Is it in your head? Or have you not done that yet? Okay. Financial sensitivity analysis. I'll touch on this here in a second. It's going to be key to do contingency planning. Contingency planning is asking those what if scenarios on your strategic managerial plan. What if no payment ever gets announced? What if these payments happen and they get paid out next year? Okay, understanding those scenarios so you have a plan in place. A lot of times the managerial planning process may not impact what we ultimately end up doing, but what it does impact is the speed at which we're able to do something. Okay, and especially giving the timing being variable on these payments, that is key. Being able to know, hey, ahead of time, this is what I already said I would do, and you can go ahead and just work on the implementation of it. Understanding your benchmarks, those financial ratios, the buffer, the risk that you're willing to assume is key. Okay, having a marketing, again, touching on those 5 managerial levers, having a marketing plan in place. If we're introducing this new risk into the fold, being able to better manage the other known risks that we can and do have tools to mitigate is going to be key. Executing your risk management plan, okay, understanding what's going to happen with family living expenses on the farm or other auxiliary expenses, transition plan. Are you keeping up to date since these ad hoc payments are going to be announced? Listening to Dr. Ifft as she puts out information when they do get announced is going to be key. So are you planning to do other educational seminars or courses? Okay, and then just how are you thinking about this managerial plan in general? So score yourself. There's a box to score yourself down in the bottom right of this. Set your goals for where you want to be and what's an acceptable level. Okay. Overall, have a plan. If you do these things, it'll help you better manage these unpredictable ad hoc payments. Okay. So some parting thoughts that Dr. Ifft and I have, and then we'll open the floor up for more questions. Right? No indication that the ad hoc era will end anytime soon. Dr. Ifft, do you have any other thoughts on the politics of when these ad hoc payments will end or into the future?
No, that's more of a disclaimer. So our signs say it will not end, but it's politics, so anything can happen.
Ultimately, control what you can control. Know your cost of production, know your financial position, the risk you're willing to assume, fully utilize the risk management strategies that we have available to us. So crop insurance, marketing, and have an explicit strategy to manage these ad hoc payments. Contingency plannings, asking those what if scenarios as you're doing these managerial plans. What happens if these payments are delayed? What happens if payments are smaller than anticipated? What happens if payments don't materialize or go away? uh, ask those contingency plans and what would you do if it happens, again, can greatly increase the speed at which you can implement solutions in each of these scenarios. So with that, Dr. Ifft, I will turn it back over to you.
Yeah, so now we have time for any questions or just feedback on thoughts on additional information or analysis that would be helpful on this topic. So the economic assistance payments, those were when the American Relief Act plan, when that was passed in December, mid to late December, there was 90 days. So we'd expect those economic assistance payments, I think it's March 20th or March 21st, to go out. For Kansas, those are going to average $30 to $39 per acre. So that's and the secretary of the nominee, Brooke Rollins, she, in her testimony, she used the term fast and furious. So she said she was committed to getting those payments out as promised in legislation. The natural disaster payments don't have a specific date. So that's one where there is some more uncertainty. There's 20 billion to cover drought related losses in 2023 and 2024. You know, we had a lot of drought related losses in certain parts of Kansas in those years, but again, how soon is USDA going to figure out how they want to do that, put out the announcement, and then get the payments out there? There's definitely some uncertainty there. Yeah, I have not heard that. That a CCC could end up being targeted. Project 2025 did have, they were proposing pretty substantial cuts to crop insurance premium subsidies, but I don't, I, yeah, I have not heard or seen any of that. So I think it's hard to say. In terms of the hearings for Secretary nominee Brooke Rollins, I think those have been relatively perhaps more straightforward, or sort of pretty strong consensus for her in terms of the number of votes she's getting and the whole process. Less controversial. So maybe there'll be less attention on the USDA, but that's getting into speculation. So there's no, yeah, we talked about this a little bit last week, this 20 billion for disaster relief. There are a lot of needs, and on top of drought damages, you have the hurricanes and other things. We had an FSA participant last week that pointed that out. There's no, the expectation is that they'll look like the emergency relief program, especially the first round, but that's not in legislation. That's just sort of an assumption that this is something that FSA has done in the past and has worked relatively well. But they could choose to do something different if they wanted to. And in terms of the speed, I think, other than the secretary's commitments to work fast, hard to say.
And I will just add on, that's kind of the motivation for me recommending higher liquidity requirements, because if these aren't paid for the next couple years, that runway to get there because of the commodity prices we're seeing, will they be paid until then or not? We really just don't know.
There's a question about what's the most likely thing that might disappear. Have you thought about that, Brady? I'm not sure. I think it's going to be a sort of a test in the next 4 years of the, I'm going to say, how much influence that the ag sector has in this administration.
Yeah,
so far that it's weak, but again, it's so early. I really don't know.
Yeah, so to the question earlier about Doge and CCC and USDA, I think there's two routes we could go with this is what is disappears or what doesn't get attention. If we're unable to get a new farm bill passed, I think it's less of what disappears and what just becomes irrelevant in terms of, you know, those formulas that are in the old farm bill not keeping up with commodity prices and such. So it's just never going to trigger a payment. So it forces us to be more in this ad hoc era of farm program payments because otherwise, if we can't politically get a farm bill passed, that it'll just be necessitated. So I don't know if it's there. There is this risk of yes, some stuff may be cut from that, but there's also this risk of just politically we can't get pushed through what we need to. So that necessitates maybe what some of the policy changes that we're talking about here.
That's a good question. So I think in terms of the next farm bill, maybe and some of the farm bills that came out in 2024 of the House did strengthen some of the Title I programs as well as some of the crop insurance. So we could see that. I guess I mean part of the question is a big focus at Congress this year is going to be on taxes. So where does the farm bill or will the farm bill be lumped into taxes? But I think it's possible, depending on, Republican Party controls all three branches. So if they choose to prioritize that, it's definitely though, if you do, especially in the current, if they do choose to prioritize strengthening Title I and crop insurance, that will have budget implications in our current price environment. So that will add on cost to the farm bill. What they do with that, that's a that's a political question. It's going to have to get worked out in Congress.
So, and then we have a question, are there potential opportunities that you foresee among all the risk? How does a producer prepare for those opportunities? So the biggest opportunity I see is flexibility in production with mitigating these risks. So the story I'll give as an example is let's say you're a farmer and you use a certain outlet to take your grain to. Maybe it's an ethanol plant, maybe it's a port or a rail shipment place. Uh, let's say the place that you typically sell the product that comes off your farm overnight goes away. Okay, and farmers in your area are also in the same boat. One would think that if you have thought through that scenario and had a backup plan, maybe there's a second opportunity to sell the product from your farm at another location. That would say maybe it would be worthwhile while stuff is still normal to maybe say instead of taking all my grain to this place, I'm going to cut off 10% and take it to this other place. May not get as high a price. Maybe there's larger trucking costs, logistics costs to get there. But what would be true is in that event, you already have that relationship built up and you can switch more quickly. And that's first mover advantage, right? So a lot of times, if you think about businesses that pivot during natural disasters, stuff like that, that first mover advantage can be huge when these external shocks happen. Okay, I know that's not a good feeling to think about to saying, oh, I'm taking advantage of when this risk happens, but it's that first mover advantage. An external shock happens to the market. Being able to pivot quickly actually presents a lot of opportunity so that you're not playing catch up when this happens. And that goes back to that contingency planning. That's the biggest opportunity I see. I mean, I presume all farmers now are managing their farm to maximize profits, and doing what's best for your individual scenario. It's asking that question, being able to pivot quickly when these strategic risks happen.
All right. Well, I'm not seeing anything else, so I think we'll call it a day for today. We do have a couple more of these coming up next Wednesday. We'll have Jenny and Robin discussing making farm program and crop insurance decisions for 2025. That includes the ARC and PLC and SCO decisions. And then in 2 weeks from now, Robin Reed and Greg Abendal will be dealing with land values and land rental rates. So we'll look forward to seeing you then and glad to have you on for today. Jenny, Brady, thank you much.